Stress is no longer confined to the margins of the U.S. financial system. It is now emerging from one of its fastest-growing and least transparent corners, private credit. Years of ultra-low rates pushed capital into non-bank lending vehicles that promise stable returns insulated from public market volatility. That assumption is breaking down. As refinancing windows close and defaults quietly rise, losses are being absorbed not by widely traded markets, but by pension funds, insurers, and private vehicles tied deeply into the real economy. This matters now because private debt is structurally illiquid, lightly regulated, and deeply interconnected with corporate cash flows. When confidence weakens in this segment, the transmission does not arrive through a single shock, but through tightening credit, frozen restructurings, and sudden repricing of risk that spills outward. The credit cycle is turning, and the mechanisms meant to contain it are untested at this scale. The rapid expansion of private credit over the past decade represents one of the most consequential structural shifts in the modern financial system, not because it replaced banks in a narrow technical sense, but because it recreated leverage and maturity transformation without the disciplining function of continuous market pricing. This shift unfolded quietly, driven by regulatory changes after the global financial crisis that constrained traditional bank balance sheets, while leaving institutional capital in search of yield. Private credit funds stepped into this gap with speed and scale, offering direct lending, unitranche structures, and bespoke financing solutions to middle-market companies, private equity sponsors, and stressed borrowers. At the surface level, this appeared to be a rational redistribution of risk from regulated banks to sophisticated investors. In practice, it produced a credit ecosystem where leverage accumulated faster than transparency, and where price discovery was episodic rather than continuous. That distinction is now becoming critically important as financial conditions tighten. During the expansion phase, private credit benefited from a reinforcing cycle of inflows, stable reported returns, and perceived insulation from public market volatility. Quarterly or even semi-annual valuation frameworks smoothed performance, reducing reported drawdowns and reinforcing investor confidence. These valuation practices were not inherently deceptive. They reflected contractual cash flows rather than traded prices. However, they also removed a key feedback mechanism that traditionally restrains leverage during late-cycle conditions. In public markets, widening spreads, falling bond prices, and equity drawdowns transmit stress signals quickly, forcing repricing, deleveraging, and capital reallocation. In private credit, those signals arrive with delay. Loans continue to be carried at par or near par values until a clear impairment event occurs. As a result, risk builds invisibly, and capital continues to flow into strategies calibrated to yesterday's conditions rather than today's realities. This structure was sustainable in an environment of declining interest rates, abundant liquidity, and strong earnings growth. It becomes unstable when those conditions reverse. As policy rates rise and refinancing costs reset upward, borrowers financed through private credit face immediate pressure on cash flows. Many of these firms operate with thinner margins and higher leverage than their publicly listed counterparts. Their financing structures assumed predictable access to rollover capital rather than outright repayment. When that access tightens, the absence of liquid secondary markets becomes a constraint rather than a feature. Borrowers cannot refinance easily, and lenders cannot exit positions without accepting steep discounts that would force recognition of losses across portfolios. This mutual illiquidity creates incentives to delay resolution through amendments, covenant resets, and maturity extensions. While such measures can preserve enterprise value in isolated cases, at scale they suppress transparency and defer adjustment across the system. The delay in loss recognition has second-order effects that compound instability. Capital allocation decisions remain anchored to stale valuations, encouraging funds to maintain exposure levels that no longer reflect underlying risk. New lending is often structured to support existing positions rather than to finance productive expansion, diverting capital toward defensive balance sheet management. This dynamic reduces the effectiveness of credit as a growth engine while preserving the appearance of stability. Over time, the gap between reported asset values and realizable exit prices widens. When a trigger finally forces revaluation, whether through a default, fund redemption pressure, or a failed refinancing, the adjustment is compressed into a short window. What might have been a gradual ray. Pricing becomes an episodic credit event with disproportionate market impact. The absence of market-based price discovery also alters investor behavior in ways that amplify systemic risk. Institutional allocators, including pensions and insurers, treat private credit as a stabilizing allocation precisely because it exhibits low reported volatility. This perception influences portfolio construction, leverage decisions, and liability matching assumptions. When private credit valuations eventually adjust, the impact is transmitted not through trading desks, but through funding ratios, contribution requirements, and balance sheet stress at institutions that underpin household savings. Because these effects emerge with delay, they are harder to diagnose and slower to address. Policymakers and supervisors receive lagged data, limiting their ability to distinguish between temporary illiquidity and structural insolvency within the system. As contraction deepens, refinancing stress becomes the primary transmission channel. Borrowers facing higher interest burdens and softer demand are forced to prioritize liquidity preservation. Capital expenditure is cut, hiring slows, and asset sales are deferred or executed under unfavorable conditions. These decisions propagate through supply chains, weakening earnings visibility for firms that may not be directly exposed to private credit markets. In this way, a valuation issue within a relatively opaque segment of finance migrates into the real economy. The process is gradual but cumulative, reinforcing macroeconomic slowdown without a single catalytic shock. For lenders, fund structure constraints intensify the challenge. Closed-end vehicles with long lockups are designed to weather illiquidity, but they also concentrate risk by preventing early exit. Open-ended or interval funds face redemption pressures that can force asset sales or borrowing against portfolios, increasing leverage at precisely the wrong moment. In both cases, the lack of an active secondary market limits options. Transactions that do occur set new price benchmarks, often well below carrying values, accelerating repricing across portfolios. This is the mechanism through which suppressed volatility is eventually released, not as a smooth adjustment but as a series of discrete valuation resets. The broader financial system is vulnerable because private credit has grown large enough to matter, but remains peripheral enough to escape robust oversight. Its connections to banks, insurers, and asset managers create channels for contagion that are poorly mapped. Banks provide leverage, custody, and derivative hedges. Insurers allocate capital under solvency frameworks that assume stable cash flows. Asset managers distribute products to investors who may not fully appreciate the liquidity profile of underlying assets. When valuations adjust, these linkages transmit stress across institutional boundaries, challenging the assumption that private credit risk is self-contained. The core issue is not that private credit exists, but that it expanded without an accompanying evolution in pricing infrastructure. Leverage accumulated in a system optimized for stability rather than transparency. In benign conditions, this design enhanced resilience by reducing mark-to-market volatility. In adverse conditions, it delays adjustment and concentrates risk. Once real-time price signals reassert themselves through forced transactions, the correction is sharper and less orderly. This is the defining vulnerability of the current private credit cycle. It does not announce itself through market panic or headline collapses. It emerges through refinancing failures, valuation disputes, and a slow erosion of confidence that culminates in sudden repricing events. As financial conditions continue to tighten, the system is entering the phase where deferred price discovery can no longer be postponed, and the cost of that delay is likely to be measured not only in financial losses, but in reduced economic flexibility at a moment when adaptability is most needed. The transmission of stress from rising defaults in private debt into the real economy represents one of the most underappreciated vulnerabilities in the current macrofinancial environment, precisely because it unfolds outside the traditional channels that policymakers and markets are trained to monitor. Unlike public credit markets, where stress is immediately visible through widening spreads, falling prices, and volatility spikes, private credit operates at the level of operating companies and contractual cash flows. Its point of contact with the economy is direct and mechanical. When a private borrower encounters distress, the adjustment does not first appear on a trading screen. It appears in payroll decisions, capital expenditure delays, supplier renegotiations, and asset disposals. This distinction fundamentally alters both the speed and the visibility of economic transmission, creating a form of slowdown that accumulates beneath the surface of headline indicators. Over the past decade, private credit has become a primary source of financing for middle-market firms, sponsor-backed companies, and asset-heavy businesses that fall outside the reach of public bond markets. These firms are not marginal actors. They employ significant portions of the workforce, anchor regional supply chains, and account for a substantial share of incremental investment. The financing structures provided to them were designed for a world of stable or declining interest rates, predictable refinancing windows, and steady end demand. Growth strategies were built on the assumption that debt could be rolled forward, extended, or refinanced rather than repaid through internally generated cash. As long as that assumption held, leverage functioned as a growth accelerant. As it breaks down, leverage becomes a constraint that forces immediate operational retrenchment. Rising defaults in this context do not resemble the discrete failure events associated with public market crises. They emerge as a continuum of stress responses. Covenant breaches lead to negotiations rather than liquidation. Interest coverage deteriorates gradually before reaching a formal default. Lenders, aware of the illiquidity of their positions, often prefer amendments and extensions to enforcement. This delays recognition of loss but does not eliminate the underlying economic pressure. Borrowers are still required to generate cash to service higher interest costs, even if principal repayments are deferred. The only available levers are cost reduction and balance sheet contraction. Hiring plans are frozen, discretionary spending is cut, and expansion projects are shelved. These decisions are rational at the firm level but collectively contractionary at the macro level. The feedback loop becomes particularly potent because private credit is concentrated in sectors that are already sensitive to demand fluctuations. Business services, industrials, logistics, healthcare services, and consumer-facing companies with leveraged balance sheets are disproportionately represented. When these firms retrench simultaneously, the impact propagates through suppliers, contractors, and local labor markets. Payment terms are stretched, orders are reduced, and inventory cycles shorten. Smaller suppliers, often operating with thinner margins and less access to credit, are forced to mirror these adjustments, amplifying the slowdown. The resulting contraction in cash flow is not confined to the original borrowers. It diffuses across entire ecosystems of economic activity. This mode of transmission complicates policy response because it lacks a single point of failure. There is no iconic collapse, no market closure, no obvious moment that signals crisis. Instead, there is a broad-based tightening of credit conditions that emerges through thousands of micro-level decisions. Traditional indicators such as equity indices or investment-grade credit spreads may remain relatively stable, giving the impression of resilience. Meanwhile, employment growth slows, productivity stagnates, and investment momentum fades. By the time these effects register clearly in aggregate data, the underlying adjustment is already well advanced, and reversing it becomes more difficult. The structure of private credit exacerbates this dynamic by limiting the speed at which capital can be reallocated. Unlike public markets, where distressed assets can be sold and repriced continuously, private credit portfolios are locked into bilateral relationships. When a borrower weakens, capital is not redeployed elsewhere. It is trapped in a defensive posture. New lending activity slows, not because opportunities are absent, but because existing exposures consume attention and balance sheet capacity. This reduces the availability of credit precisely when firms need flexibility to adapt to changing conditions. The contraction is therefore self-reinforcing, driven as much by opportunity cost as by realized losses. Labor markets are a critical transmission channel in this process. Firms financed through private credit tend to be labor-intensive and regionally concentrated. When financing stress emerges, labor is often the most adjustable input. Hiring freezes are implemented early, followed by reductions in temporary staff and contractors. Permanent layoffs occur later, but the chilling effect on labor mobility and wage growth appears quickly. Workers become more cautious, consumption growth slows, and local service economies weaken. These effects accumulate quietly, contributing to broader economic deceleration without triggering immediate alarm. Asset sales represent another mechanism through which private credit stress transmits into the real economy. To preserve liquidity, firms may divest non-core assets, sell real estate, or unwind subsidiaries. In a synchronized environment, these sales occur into thin markets, depressing valuations and reducing recovery values. This not only crystallizes losses for borrowers, but also affects asset prices more broadly, particularly in commercial real estate and specialized industrial assets. Lower asset values weaken collateral positions, tightening credit further and reinforcing the cycle of retrenchment. From a financial stability perspective, the danger lies not in a sudden collapse but in the erosion of economic resilience. Because private credit stress unfolds gradually, it blunts the effectiveness of countercyclical policy tools. Central banks can ease financial conditions, but lower policy rates do not immediately repair balance sheets strained by high leverage and reduced cash flow. Fiscal interventions can support demand, but they are often blunt and slow to reach the specific firms under pressure. Moreover, the opacity of private credit markets limits the ability of policymakers to target interventions accurately. By the time stress is visible at the macro level, the micro-level damage is dispersed and entrenched. The international dimension adds another layer of complexity. Many private credit-financed firms are integrated into global supply chains, either as exporters, importers, or intermediate producers. As they retrench, trade volumes soften and cross-border cash flows become less predictable. This can exacerbate external imbalances for economies reliant on trade-intensive sectors. Emerging markets that supply inputs or absorb finished goods feel the effects indirectly, even if their domestic financial systems are not heavily exposed to private credit. The slowdown thus propagates globally through real economic channels rather than through financial contagion in the traditional sense. Crucially, the political economy implications of this process differ from those of market-driven crises. There is no obvious villain, no dramatic failure to catalyze reform or emergency action. Instead, there is a diffuse sense of underperformance, declining opportunity, and constrained growth. This can erode confidence in economic institutions and policy frameworks over time, even in the absence of acute instability. The quiet nature of the adjustment makes it harder to mobilize consensus around corrective measures, increasing the risk that the slowdown becomes structural rather than cyclical. As defaults in private debt continue to rise, the cumulative impact on the real economy will depend less on headline default rates than on the duration and breadth of the adjustment. Prolonged periods of balance sheet repair suppress innovation, investment, and productivity growth. Firms focused on survival defer strategic initiatives and workforce development. The economy becomes less dynamic, more risk-averse, and more vulnerable to external shocks. This is the central risk posed by the current private credit cycle. It does not threaten immediate collapse, but it undermines the capacity for recovery by constraining the real economy at its most operational level. The longer this process persists without transparent recognition and resolution, the greater the long-term cost in terms of growth, employment, and economic flexibility. As December 26, 2025, unfolds with persistent tensions in global credit markets, the inherent limitations of the shadow banking structure in containing contagion emerge as a critical impediment for policymakers, amplifying vulnerabilities in private credit ecosystems that operate predominantly outside conventional regulatory safeguards. This constraint is particularly alarming at this juncture because private credit, now encompassing an estimated $3 trillion in assets as of early 2025, faces mounting stress with defaults easing marginally to 5.2% in October, but projected to remain fragile into 2026 amid decelerating growth and refinancing pressures. Embedded within a broader geopolitical landscape characterized by U.S.-China tariff escalations that have inflated import costs by 7-9% and disrupted supply chains, this opacity in shadow banking, lacking standing liquidity facilities, deposit guarantees, and comprehensive supervisory oversight, delays data flows and fragments responses, complicating efforts to preempt spillovers. Institutional exposures through pensions and insurers, holding significant portions of the $1.7 trillion in private credit AUM, translate valuation pressures into household wealth erosion and heightened long-term liabilities, generating political sensitivities that constrain fiscal maneuvers. The deeper structural risk lies in the potential for credit retrenchment to contract overall lending capacity, as private debt does not seamlessly revert to regulated banks, potentially evolving a contained correction into a broader slowdown fueled by funding scarcity rather than mere demand weakness, especially as global financial stability risks remain elevated with stretched asset valuations and sovereign bond pressures. Historical precedents illustrate how shadow banking's regulatory gaps have repeatedly hindered contagion management, as seen in the 2008 global financial crisis, where off-balance sheet vehicles and non-bank lenders amplified subprime mortgage losses, overwhelming policymakers with delayed visibility and forcing ad hoc interventions like the Troubled Asset Relief Program. Similarly, the 2020 pandemic liquidity crunch exposed vulnerabilities in money market funds and private credit, prompting the Federal Reserve's emergency facilities but revealing policy failures in preemptive oversight, as non-banks evaded Basel III capital rules through arbitrage. The current configuration, however, is structurally more dangerous due to the exponential growth of private credit from $1 trillion in 2023 to $3 trillion in 2025, far outpacing the 2000s structured product boom, with limited supervisory tools under the Dodd-Frank Act failing to adapt to this scale. Unlike past episodes where bank-centric regulations provided partial containment, today's environment features fragmented oversight, as evidenced by the Federal Reserve's 2025 policy statements on novel activities for state banks, which withdraw prior constraints but do not extend liquidity backstops to shadow entities, exacerbating delays in data aggregation and response calibration amid geopolitical strains like sanctions that push capital toward unregulated channels. This evolution heightens the risk of moral hazard, as interventions in 2023 banking stresses inadvertently encouraged further migration to private credit, now embedding systemic fragilities without the transparency that mitigated earlier crises. Delving into the mechanisms, the shadow banking constraint originates from private credit's operation outside traditional nets. Without deposit insurance or lender of last resort access, stress indicators like the 5.2% default rate in October 2025 transmit unevenly, with supervisory visibility limited to periodic reports under the Financial Stability Board's global monitoring, delaying detection of leverage multiples often exceeding 6 times EBITDA in middle market deals. Step by step, this opacity intersects with capital flows. Institutional investors, allocating 15–20% of pension and insurance portfolios to private credit, face infrequent valuations that mask deteriorating cash flows, prompting abrupt de-risking when defaults rise, as seen in the 10.9% rate for smaller EBITDA issuers. Debt dynamics are pivotal. Ballooning deficits absorb liquidity, crowding out private lending and elevating yields, while inflation at 2.7% erodes real returns, straining borrower coverage ratios below 1.5. Labor markets contribute through softening demand, with unemployment at 4.6% moderating wages and constraining consumer-driven sectors reliant on private funding. Policy logic perpetuates fragmentation. Regulatory arbitrage, as highlighted in 2025 analyses of shadow banking under securities law, allows non-banks to evade capital requirements, but without tools like the Federal Reserve's internal liquidity stress tests extended to these entities, responses lag, fostering contagion as wealth effects from valuation pressures impact household spending, which constitutes 70% of GDP. Market signals are incorporating these constraints, with equities and financial intermediaries dipping 2–3% amid fears of private credit contagion, as bank stocks reflect exposures totaling $4.5 trillion to non-banks per IMF estimates. Bonds exhibit selective widening, with high-yield spreads increasing 45 basis points quarterly as transparency deficits prompt premiums for illiquid holdings. Currencies adjust through dollar strength masking underlying outflows, while commodities soften in industrial segments tied to borrower health. Institutional behavior underscores the issue. Rotations from private credit funds, with outflows noted in Q3 2025 surveillance, hedge against valuation opacity, interpreting delayed data as precursors to defaults stabilizing around 1.5% for leveraged loans, but with fragility persisting. Markets react preemptively because algorithmic models capture covenant breaches before supervisory reports, allowing de-risking that embeds losses prior to public awareness of spillover risks. Government and central bank capabilities are severely curtailed, with realistic options limited to indirect measures like expanding repo facilities to include non-bank collateral or enhancing reporting under the 2025 Global Monitoring Report on Non-Bank Intermediation, potentially provisioning $30–40 billion in buffers. They cannot extend deposit guarantees or liquidity backstops without legislative overhauls, as such actions would amplify moral hazard in a sector thriving on arbitrage, risking inflation resurgence if funding scarcity contracts lending by 10%. Credibility is jeopardized, fragmented oversight as per F. Federal Reserve's 2025 statements on permissible activities invites backlash amid political pressures for bailouts, yet trade-offs abound. Stabilizing interventions might prevent slowdowns but entrench dependencies, heightening fiscal sensitivities as pension exposures erode household wealth. The spillover implications extend broadly, with the United States facing amplified fiscal strains from credit contraction shaving 0.51% off GDP, constraining household and corporate balances. China encounters indirect pressures via supply chain disruptions, prompting stimulus that risks global overcapacity but buoys renminbi settlements. Russia and BRICS economies, responding to U.S. stress through expanded local currency trades and guarantee funds launched in 2025, deepen fragmentation, potentially reducing dollar demand and fostering alternative systems that heighten volatility. Europe grapples with ECB limitations, where insurer exposures to U.S. private credit necessitate 35 billion euros in aid, slowing normalization. Emerging markets bear outflows of $140-200 billion, elevating yields by 150-200 basis points and widening deficits, with trade rerouting exacerbating mismatches in dollar debt. Financial consequences include cross-border volatility, overburdening IMF resources by 15-20%, and accelerating de-dollarization in BRICS payment initiatives. Escalation occurs through self-reinforcing loops, where opacity delays responses to defaults at 5.2%, prompting institutional sales that depress valuations and feed wealth erosion, contracting credit further. Second-order effects involve bank exposures drawing down lines, reducing lending by 8-10% and impairing growth. Third-order ramifications encompass equity contagion, with multiples falling 10-12% amid funding scarcity. Triggers include tariff maturations inflating costs by 8-10% or default clusters in Q1 2026 exceeding 6%, accelerating deterioration. Projecting into 2025-2026, short-term trajectories anticipate contained stress with defaults easing below 5% by mid-2026 if oversight enhances, though opacity persists, muting rebounds. Medium-term consequences involve structural contractions, with lending capacity down 10-15%, hindering productivity. This reshapes power dynamics. U.S. dominance erodes as BRICS alternatives gain traction, diminishing reserve status by 5-7%, while emerging stability falters from scarcities, inciting unrest. Financial architecture evolves toward integrated non-bank regulations, yet lags prolonged vulnerabilities. In conclusion, the shadow banking limitations on contagion containment represent a foundational flaw in financial resilience, with compiled evidence underscoring the need for expedited oversight reforms to avert pervasive economic impairments.